and a very warm welcome to yet another interesting edition of the program CAC Weekly, a weekly program that keeps you abreast on the activities and the achievements of the Corporate Affairs Commission. I am Amina Jibril. Now, coming up on CAC Weekly, on CAMA 2020, company law specialist brings us up to speed on the new insolvency regime. Plus, do you know that you can register your company directly online without any agent? Well, we'll be right back after this break. Do stay with us. Welcome back. We begin with the reenacted Companies and Allied Matters Act, CAMA 2020, alias the Game Changer. Today, we'll be taking a look at insolvency as enshrined in the CAMA 2020. What then is insolvency? Investopedia.com defines insolvency as a term for when an individual or company can no longer meet their financial obligations to lenders as debts become due. Before an insolvent company or person gets involved in insolvency proceedings, they will likely be involved in informal arrangements with creditors, such as setting up alternative payment arrangements. Insolvency can arise from poor cash management, a reduction in cash inflow, or an increase in expenses. Key takeaways on insolvency. Insolvency is a state of financial distress in which a person or business is unable to pay their debts. Insolvency in a company can arise from various situations that lead to poor cash flows. When faced with insolvency, a business or individual can contact creditors directly and restructure debts to pay them off. In a paper titled Insolvency by Alicia Tuavila, reviewed by Thomas Brock, released on 15th March 2021, insolvency was further described as a state of financial distress in which a business or a person is unable to pay their bills. It can lead to insolvency proceedings in which legal action will be taken against the insolvent person or entity, and assets may be liquidated to pay off outstanding debts. Business owners may contact creditors directly and restructure debts into more manageable installments. Now, creditors are typically amenable to this approach because they desire repayment, even if the repayment is on a delayed schedule. If a business owner plans on restructuring the company's debt, they assemble a realistic plan showing how they can reduce company overhead and continue carrying out business operations. The owner creates a proposal detailing how the debt may be restructured using cost reductions or other plans for support. The proposal shows creditors how the business may produce enough cash flow for profitable operations while paying its debts. Contrary to what people believe, insolvency is not the same thing as bankruptcy. It is now time to take a look at the new Insolvency Framework as encapsulated in the CAMA 2020. CAC Weekly caught up with Justin Nidia Birao, Director but Secretariat, who x-rays the new insolvency regime to us. Do enjoy watching this interview.
Many thanks for joining us again.
Thank you for having me.
Okay. Today we're looking at the new insolvency framework. I do know we have treated it some time ago, but maybe it is going to be a refresher or we have some other new things to add. But before we go into the details, what exactly is the new insolvency framework?
Well,
and what is the thinking behind it?
Well, what we will basically note about the new insolvency framework is that there are three in number. One is what we call company voluntary arrangement.
Okay.
Two is what we call company administration.
Okay.
And three is what we call netting.
Okay.
Our concentration will be basically on the first two.
Okay.
Because the third one, which is netting, is available to parties that companies that are parties to financial contract.
Okay.
So that is more or less restricted to players in the financial industry.
Okay.
Yes.
All right. So let's go to the objective. What's the objective?
The objective actually is that before now, it was noted over time that most of the insolvency regime or frameworks that we have inevitably led to liquidation of companies. with the attendant consequences of job losses, loss of income for directors, and generally also dislocation of the economy. So it was thought that it would be better if the companies are given a second chance to come back to life, so that it will save job and save income for the directors.
Okay, so for the purpose of the understanding of our viewers, help us break down the two. You said the third one is not popular with the players in the industry. So let's help them understand what the company voluntary arrangement is. That's the first one.
Well, first of all, let's talk about the conditions.
Okay.
About the conditions that will necessitate invocation of the true insolvency framework.
Okay, go ahead.
Basically, it is required that when a company is unable to pay its debt, then it is technically called insolvent. And therefore, either of the parties that have been classified under the law could apply for the insolvency solutions that have been provided by the law. And for company voluntary arrangement in particular, as you can see, the initiative should come from either the directors or the members of the company. And what they need to have is that there will normally be a proposal for them indicating how they want to pay their debts going forward, how they will restructure the debt so that they will be able to pay back the debt and now come back to operate as they were doing before.
Okay.
Yeah.
Okay, these are the conditions.
The basic condition is that there should be what we call business restructuring plan, which you now take to the creditors and the members of the company.
Okay.
Once it is approved by the two parties, then you implement it.
Okay.
Yes.
Okay. So then we can now go to the two and talk about the two, isn't it? Now that we've known the basic condition for that. Yes. So we start with the company voluntary arrangement.
Well, the company voluntary arrangement is the one we have said is usually initiated by either the directors or the members of the company.
Okay.
But basically, since the directors are the ones that are managing the company, the initiative of company voluntary arrangement should come from them. And like we said before, what will necessitate them to invoke the company voluntary arrangement is that there is what we call insolvency. And insolvency, we said, is inability to pay debt as and when due. So when a company realizes that it is not able to pay its debt as and when due, then it will prepare what we call a repayment plan. And it will approach its creditors and the members to approve the repayment plan. Once the repayment plan is approved, then it will now implement it. The idea is that if it now pays back the debt, it will go back to its original status of operation, in which case it will pay its debt now as and when due.
Okay, so then the administration, the company administration.
The company administration has also three components.
Okay.
What it means is that it can be initiated by about 3 persons. There is one that we call company administration, which is initiated by either the company or the directors. That is one. Then there is one that is initiated by what we call holders of floating charge. Then the third one is the one that is invoked directly by the court. That's court-centered company administration. Each of them have separate requirements.
Okay. I'm just wondering, somebody listening to you, how easy would all of this process be?
Well, what we will advise actually is that, like we say, generally, the insolvency practice would require specialists So the specialist is now
will be the one to advise.
will be the one to advise people as to which one you will go for. Is it the one that is invoked by holders of floating charge, or is it the one that will come from the company, or is it the one that will come from the court?
Okay, what is the time frame from initiation to completion?
No, there is no time frame as such,
Okay.
because what we will note with the new insolvency framework is that what we call quasi-judicial processes. So at any point in time, you would need the intervention of the court, either by way of what we call order, a formal order of the court, or just the court approval for you to proceed. So because of the involvement of the court, it will be difficult for you to give it a time frame.
Okay, so let's go to the relationship of the new insolvency framework and the old one, because there's an old one that was existing before now.
Yes, before
any relationship?
Before now, we had what we call liquidation, which could be either voluntary or a compulsory liquidation. Then we have receivership, which were the major ones that we had before now. But like we said before now, most of these insolvency framework that were available before now eventually led to the death of the company. So, but this new framework, what it tries to do is that it puts it a duty upon the insolvency practitioners to try what we call business rescue, because the other name for the new insolvency framework is business rescue. So it puts a responsibility on the insolvency practitioners, first to try the business rescue. And it is only when that is not possible that they will now liquidate the company. So that is the beauty with the new insolvency framework, that practitioners should always try to ensure that they give the company a second chance of bouncing back to life before they consider any other option.
Okay. So let's go to the implementation of the insolvency framework, the new insolvency framework. What is it like? What is the implementation like?
Well, the implementation requirements for the new insolvency framework could be divided into two. There is the responsibility of the Chief Judge of the Federal High Court to review court processes in view of the new requirement that insolvency practitioners should try to rescue companies. So it is expected that the procedure, the insolvency procedure for the Federal High Court should be reviewed to align it with the new requirement of the law. Then there is the part that is for the Commission. We are also supposed to review our processes to realign with the new requirement of the law. So what the Commission has done is to do a draft, to produce a draft regulation for implementation of the new insolvency regime. That is still in the process. Very soon, internal processes that is required for that implementation will be completed, and the draft will be exposed to the members of the public for comments. When that comments is received, then the draft will be reviewed in line with the recommendations that would come. Then when it is reviewed, it will now be formally issued. Then the Commission can now start receiving applications on those new procedures.
So these are the two, the Chief Judge and the Commission.
Yeah, those are the people that are supposed to produce rules for implementation of the district. What we have done is to produce regulations that will enable the Commission to receive the application its own application, while we leave the responsibility of reviewing the insolvency or what we call liquidation processes with the Federal High Court.
Okay.
Yeah.
All right. So let's go to the practitioners now. Who is qualified to be an insolvency practitioner? Can journalists like me qualify for insolvency practitioner since it's a new area?
Well, the CAMA, the Companies and Allied Matters Act,
2020.
2020, basically provides that the Commission should actually accredit insolvency practitioners. And it goes further to try to identify those that will be entitled to be accredited by the Commission for purpose of being insolvency practitioners. The Commission recognizes the chartered accountants, chartered secretaries, and legal practitioners. And also recall the Act recognizes members of BRIPAN. By BRIPAN, we mean those that are members of that association.
Okay.
Okay, but what the Act tries to do is that you will not just be a member of either of these profession, but that you will be required to accredit to the Commission formally before you become an insolvency practitioner.
Okay.
Yeah.
Okay. But because the lawyer, the chartered accountant, and the lawyer, they're already agents of the Commission.
Yes.
So can they just, take wear a double cap of still be, insolvency practitioners?
No, not necessarily.
Okay.
For the fact that being a member of the legal profession or a member of chartered accountants may not necessarily give you the experience required for an insolvency practitioner.
So what will give you the experience?
Well, there is supposed to be what we call a tutelage under firms, or either firms of chartered accountants or legal practitioners that have been doing insolvency practice over the years. So if somebody goes through a tutelage under those firms, then he will have the requisite experience to apply for accreditation as an insolvency practitioner. So there will be, apart from those that have experience at the moment, there will be a requirement that you will have some basic experience in insolvency practice before you are accredited as an insolvency practitioner.
Okay, so there will be capacity building for some time.
Well, there will be capacity building both from the Commission and from industry players for the professional groups in particular.
Okay, so when is this new insolvency framework taking up?
Well, like we said, we have not yet fixed time for it to take off. It will depend on how we are able to get approval for the insolvency regulations.
Okay.
Because the insolvency regulation by law is required to be approved by the minister.
Okay.
So once the minister gives the ministerial approval for the regulation,
Okay.
then the Commission will commence implementation.
Okay, so we should expect it anytime next year, 2022?
By the grace
Because
of
2021 is already going.
well, by the grace of God, we are hoping that early next year we will start implementation.
Okay, so now let's go to the expected benefits for the economy, because before now, companies that goes into liquidation, that's the end of the story. But now they have an opportunity to bounce back, isn't it?
Yeah.
Okay.
Well, it could be seen that the benefits are obvious, isn't
Saving
it?
jobs.
First of all, the dislocation that normally comes from winding up your company is avoided. And what it means is that you save jobs, That's the first thing. Then, you know, a company that is functional also has a lot of benefits because it has its customers that distribute its products. Then you also have suppliers that supply possibly raw materials to the companies. Then you have employees of different departments that are. Then you also have even the consumers of the product of those companies. So you can see that there are a lot of people depend.
So you are saving a whole value chain.
You are saving a whole value chain that cuts across different strata of the society. So that basically is the advantage that the new insolvency framework tries to bring in for the companies.
Okay. Does it also create some kind of sanity in the business environment?
Well, yes, to an extent, but primarily what it tries to do is that, you know, there are risks in business. Sometimes the risk might not be foreseen when you are establishing the business. So it tries to manage unforeseen risk for the enterprises. So that, for instance, if a business runs into a risk that is likely to threaten its existence, through what we call business rescue mechanism, you can address that risk and give a platform for the company to come back to life. So to a certain extent, it's like it provides a sort of cushion for the directors who could have lost their jobs, then for the investors who could have lost the entirety of their investment. So it tries to provide a cushion for the directors, for the investors, for the employees, for suppliers, and even for customers of the company.
Mr. Lydia Justin, thank you very much indeed for your time as always.
Okay, thank you very much.
All right.
And from that interview, we now move on to show you how to register your company online directly without any agent. It is so easy.
Business name registration. Now that we have reserved the name, let's now proceed to register the business. Step 1. On your dashboard, click on the Reserve panel. This would bring up your approval history. Step 2. Click on the Start Registration button beside your approved name. Step 3. Under Business Details, enter your business details and click on Save and Continue. Step 4. Under Particulars of Proprietors, enter the particulars of each proprietor and click on Add Particulars of Proprietor button, then click on Save and Continue. Step 5. Under Nature of Business, enter the nature of business and describe the business by filling in the Other Nature of Business description box and click Add Nature of Business button to add, then click the Save and Continue button to proceed. Ensure you fill in all fields marked with a red asterisk. Step 6. Under Document Upload, scan the means of identification you chose in Step 4 and upload it by clicking the Upload button. Upload the scanned versions of your signature and passport photograph. Click on Save and Continue to preview your entries. Step 7. When you have verified your entries, click on Proceed to Payment to pay for your registration. Remember to remain on the remitter page after you have received a confirmation of payment. You will be automatically redirected to your dashboard where you can download your receipt. When your registration has been approved, your certificate will be automatically generated on your registered panel where you can download and print it.
And that does it for this week's edition of the program, CAC Weekly. We do hope you enjoyed watching. Remember, for comments and inquiries, you can please take advantage of our social media handles and our helplines. On Instagram and Facebook, it is Corporate Affairs Commission. Our email is cservice@cac.gov.ng. You could also visit our website via www.cac.gov.ng. And our helplines are on the numbers 081 822 99016 or 081 822 98971, 090 874 01598 or 090 874 01599 and 090 874 01600. Do join us next week for another interesting edition of the program, same time and same station. From me, Amina Jibril, and the whole team here, it is bye for now.